Are you worried about seeing your wealth shrink in the next crisis? Have you ever wondered which stocks can not only survive but continue paying dividends while the market crashes? In times of high volatility, many investors make the mistake of fleeing from variable income or betting on fragile assets that cannot withstand economic stress. In this video, we will reveal the safest dividend stocks to protect your money during turbulent periods, based on historical data and past crisis analyses. If you seek security and financial stability even when the market is down, this content is essential. We will show how resilient companies have behaved in critical moments and how you can build a bulletproof portfolio against market uncertainties. Stay until the end and discover which assets offer real protection for your capital and keep your passive income intact, even when everything seems to collapse. Before we begin, leave your like and subscribe to the channel to receive more content like this, helping you make smarter and safer decisions for your financial future. If you fear that your money will lose value or that your dividends will be cut during crises, you are not alone. Many conservative investors share this concern, especially in periods of recession and high volatility. But what if I told you that some stocks can protect your capital even in the most turbulent market moments? In this video, you will discover which are the safest dividend stocks in times of crisis and how they can shield your wealth against economic shocks. Do you want to ensure financial stability when everyone else is panicking? Then stay with me until the end and leave your like, because today we are going to talk about protection, consistency, and returns in any scenario. Before we start listing the most resilient stocks, it is important to understand why conservative investors, especially those between 30 and 60 years old, should prioritize capital preservation during economic uncertainty. The fear of losing wealth or having dividends reduced in times of recession is legitimate and recurrent. Historically, crises like the one in 2008 or even the turbulence caused by the 2020 pandemic show that while some companies fail, others continue delivering solid and consistent results. These are the companies with strong fundamentals that we will explore today. Imagine going through a global crisis and still receiving regular dividends from companies that maintain their payment capacity, even when the market is in free fall. These assets exist and stand out by presenting common characteristics: defensive sectors, resilient business models, and a consistent history of dividend payments. We will analyze each of these characteristics in depth throughout this video. By the way, make sure to subscribe to the channel and activate notifications, as we always bring strategic content like this to protect and grow your wealth. Let's start with the sectors considered the most offensive during crises: electricity, basic sanitation, and food. Companies in these industries have inelastic demand. That is, they remain essential regardless of the economic scenario. For example, electricity companies have historically maintained stable cash flows even during deep recessions, ensuring dividend distribution. And when looking at past crises, we see that utilities, such as electric and water companies, have performed better than the general market, offering protection and passive income to their shareholders. Now, let's dive deeper into the analysis of essential financial metrics to identify safe dividend stocks during crises. Companies with low debt levels, high free cash flow, and a healthy payout ratio are the ones that can maintain payments even when the market tightens. Moreover, companies with solid balance sheets tend to better withstand economic fluctuations and preserve their dividend policy. A classic example is Coca-Cola, which has maintained and even increased its dividends for decades amid various global crises, demonstrating the power of resilient and financially disciplined businesses. Another fundamental point to consider is the concept of dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. These companies not only pay dividends, but also consistently raise them, even during challenging economic cycles. This demonstrates a management team committed to shareholder remuneration and a resilient business model. In the United States, names like Johnson & Johnson, Procter & Gamble, and McDonald's are on this list and have demonstrated strength during the crises of 2000, 2008, and 2020. In Brazil, although we do not have an official list of aristocrats, companies like TISA and Engie Brazil are references in consistency and safety in dividend payments. But how do you identify good buying opportunities for these assets during crisis? The answer lies in valuation analysis. focusing on metrics such as an attractive but sustainable dividend yield and discounted multiples like PE and P/BV during widespread market downturns. Even solid companies tend to be traded at prices below fair value, representing rare opportunities to acquire high-quality stocks at advantageous prices. In this sense, crises can be great allies for patient and meticulous investors. By the way, if you are enjoying this content, don't forget to leave your like so we can continue bringing in-depth analyses like this. Another critical aspect is sectoral diversification. Even when selecting safe dividend stocks, it is crucial not to concentrate too much on just one sector, such as electricity or finance. Diversification reduces specific risks and enhances your portfolio's resilience during instability. Distributing capital among defensive sectors and even dollarized assets can protect investors from systemic shocks in a single industry or region. And remember, capital protection during crises is not just about choosing good companies, but structuring a cohesive and strategically positioned portfolio. Speaking of dollarized assets, it is essential to highlight the role of REITs, real estate investment trusts listed on American stock exchanges, which have historically also performed well in times of economic stress. Some REITs focus on sectors such as healthcare and data centers, continued paying strong dividends even during the 2008 and 2020 crises. They offer conservative investors a way to diversify their passive income beyond the Brazilian market, mitigating currency risks and expanding the range of protection. Moving forward in our crisis protection strategy, we have a crucial factor: companies' cash management policies. During recessions, companies with robust cash reserves have a greater ability to honor dividends and even take advantage of opportunities to acquire weakened competitors. Companies that maintain healthy cash reserves, such as WEG and Itaúsa, have shown a defensive and strategic stance over the years, being able to not only protect dividends but also grow in challenging scenarios. Furthermore, we need to talk about the psychological effect of crises on the behavior of the conservative investors. The fear of loss leads many to liquidate positions prematurely, compromising both wealth and future dividend generation. Having clarity about the solidity of the companies in your portfolio and adopting a long-term vision is essential to maintaining discipline and avoiding emotional decisions. In fact, during previous crises, investors who held on to resilient companies collected dividends and saw their assets appreciate after economic recovery. Another relevant chapter concerns analyzing the history of dividends in past economic cycles. We will now look at concrete data on how leading dividend-paying companies performed during the last three major crises: the dot-com crash in 2000, the financial crisis in 2008, and the 2020 pandemic. Data shows that companies like Procter & Gamble and Johnson & Johnson not only maintained, but increased their dividends during these periods. This history proves that by choosing the right stocks, conservative investors can turn a crisis scenario into an opportunity for profitability and protection. Reaching the final stretch of our content, I would like to talk about the importance of time in building a secure dividend portfolio. For conservative investors, the concept of investing for the long term has never been more important. Crises are cyclical, but the market tends to recover over time, and companies that maintain a solid dividend policy have a greater chance of overcoming moments of adversity. Patience and discipline are essential for those who want to reap the rewards of dividends over the years. In this sense, dividend reinvestment, as we discussed earlier, can accelerate the process of wealth growth. Moreover, companies that stand out for paying regular and growing dividends, like those mentioned throughout this video, not only offer security, but can also become fundamental pillars in a long-term portfolio. The key is to buy good companies and wait for the power of dividends and capital appreciation to manifest over time. The secret is to resist the temptation to sell during short-term volatility and focus on long-term growth potential. If you want to learn more about how to build your long-term dividend portfolio, subscribe to the channel and don't miss the upcoming videos, which will always bring more practical tips like these. Finally, let's reflect on the role of discipline and financial planning in protecting your wealth during times of crisis. Even the safest dividend stocks are not immune to periods of market decline, but the difference lies in how you prepare for these adversities. The key to getting through difficult times without significant losses is to adopt a consistent strategy and stay calm during market storms. Having a well-defined asset allocation strategy that combines dividend stocks with other protective assets, such as fixed income and real estate funds, can be the key to ensuring that your wealth is not negatively impacted during crises. Furthermore, financial education is one of the greatest allies of any investor. By understanding the fundamentals of the companies you invest in and the impact of crises on the market, you become more resilient and prepared to make intelligent decisions. Warren Buffett, one of the most famous and successful investors in the world, is a classic example of someone who knew how to invest strategically and conservatively, especially in times of crisis. Although he is widely known for his value investing approaches, his ability to identify solid companies that pay dividends is also a key piece of his long-term strategy. In the 2000s, during the global financial crisis, which had a devastating impact on markets worldwide, Buffett maintained a calm and focused approach. He knew that despite market volatility, good companies would continue to generate profits and pay dividends. During the 2008 crisis, when the collapse of major financial institutions and the market down and affected millions of investors, Buffett not only maintained his positions in dividend stocks, such as Coca-Cola and Procter & Gamble, but also made new investments in stocks that offered attractive dividends, like American Express. One of the key points of Buffett's success during the crisis was his ability to identify companies that, although suffering from an unstable market, had resilient business models and a strong ability to generate cash flow. He always focused on companies that were well-positioned to survive economic difficulties, and that paid consistent dividends. This included sectors such as consumer goods, healthcare, and energy, which have relatively inelastic demand regardless of economic conditions. Notable example was his investment in Coca-Cola. Even when the stock was discounted during the crisis, he knew that Coca-Cola's brand power, its global distribution network, and the stability of its profits meant the company would continue generating solid cash flows. This allowed Coca-Cola to maintain its dividends, offering investors like Buffett a constant source of passive income. What many don't know is that during this crisis, many companies began cutting or even suspending their dividends, while others, like Coca-Cola, continued paying them. This gave Buffett a significant advantage because he remained in a safe position, a portfolio that generated regular cash flow even in times of crisis. Moreover, Buffett has always emphasized the importance of dividend reinvestment. During the 2008 crisis, by reinvesting his stock dividends, he was able to increase the value of his holdings over time. He knew that the effect of compound interest could further boost his returns. This strategy was particularly effective during the market recovery, as he accumulated more shares of dividend-paying companies that began to recover quickly, generating even more passive income in the process. The 2008 crisis was a significant test for many investors, but not for Warren Buffett. He saw the situation as an opportunity to continue investing strategically, focusing on companies with solid business models, stable profits, and a strong dividend policy. He always said, "There is nothing more advantageous than receiving dividends from companies you already own while their stocks continue to appreciate." This conservative, dividend-focused approach helped Buffett not only survive the crisis, but also prosper in the long term. While many investors sold their stocks in panic, Buffett remained firm, knowing that dividends were a sign that companies were well-positioned to recover in the future. He stuck to his long-term strategy, and as a result, his holdings grew exponentially, a lesson for conservative investors. Warren Buffett's story during the 2008 crisis is a perfect example of how a dividend stock strategy can be effective, especially for conservative investors seeking financial stability and capital protection. During times of economic uncertainty, Buffett knew that companies with a strong history of dividend payments, solid management, and resilient business models were an excellent way to ensure not only capital protection, but also a constant source of passive income. For conservative investors, the lesson here is clear. During crises, the focus should be on companies with stable cash flow and a consistent dividend policy. Even in difficult times, these companies can offer a safe harbor, as dividends can continue to be paid, providing regular passive income. Furthermore, reinvesting these dividends can accelerate the construction of a more robust portfolio and increase long-term profitability. If you are a conservative investor, always look for solid companies with good governance and a consistent dividend policy. This type of investment can be the key to protecting your wealth and ensuring your financial peace of mind. even in times of crisis. And to conclude, a strategic reflection. Crises are inevitable, but you can decide how to face them. Choosing safe dividend stocks and adopting an analytical and disciplined approach are the best tools to protect and grow your wealth, even in the most challenging scenarios. If you value stability, capital protection, and continuous passive income, you now know how to structure your portfolio to achieve these goals. And of course, if this content made sense to you, subscribe to the channel, activate notifications, and leave your like to support our work and continue receiving exclusive and strategic content like this.